Hi, this is Shubhankar Chakravarti from American Academy of Financial Management. We are taking a look at some of these queries being sent by our viewers and candidates. तो देखते हैं आज का query क्या है. So the query is, how does credit risk premium impact bond investment? Can you discuss the factors that affect the credit risk premium and explain why investors require higher return for investing in bonds with higher credit risk? Additionally, how does credit risk premium vary across different credit ratings? So let us understand what is credit risk premium. So credit risk premium basically represents the additional compensation or the additional return that investor will demand for taking the risk of default. So यहाँ पे अगर कोई issuer default कर जाता है, so there is a complete loss of principal. All right, it's a total loss of principal. All right, or maybe partial loss of principal. So loss of principal को लेने के लिए, risk लेने के लिए, वो loss का risk लेने के लिए, what is the additional compensation that the investor is getting or the investor is demanding is something which is called credit risk premium. Okay. So what are the factors that affects credit risk? The first is credit rating of bond issuer. If the credit rating of bond issuer by the credit rating agencies, which are like Moody's, S&P, Fitch, अगर इनके rating के अनुसार a particular bond issuer is rated at a higher level, so that means there is a huge trust that this issuer is not going to default. Okay, and as much of trust that it will have, that the particular bond will have, the premium will be low. So technically, if you are investing in a bond which is having higher rating, the issuer is having higher rating, then you need not to worry much about your principal loss. और इसके लिए आपका जो premium है, वो premium भी कम में investor invest कर देंगे. All right, but if your credit rating is not so good, let's say हम लोग AAA, AA इसको हम बोलते हैं कि they are very high in terms of their credit rating, but let's talk about A plus or B category के कुछ bond ले लो, तो वो bond में risks are very high, and that's why you see a very high yield in those bonds, very high return on those bonds, because there is a very high chance that those bonds might default and they might not be able to return your money partially, or they might default completely. All right, so that is the first factor. The second factor is economic conditions. So let's say you are in a position where your economic conditions are very bleak, something that happened during COVID. Everything was shut down, so you are giving out money to someone, so you are lending money. Basically, credit, आप जब credit bond में invest करते हो, तो आप क्या करते हो, उधारी का ये धंधा है, तो उधार दे रहे हो आप किसी को, तो there is a very high chance that person might not be able to return your money because economic condition is not good, and in such situations his business might not run properly and he might not be able to give you good returns. So which is why the credit rating at that point will be the credit risk premium at that point will be very high, because you will be lending money, but you would want a sizable return on that, a sizable compensation on that. But if your economic, like we have seen that when the economic conditions went better, all of a sudden the yield has started coming down. So the return on investment has started coming down. All right, people have started demanding less premium for their investment. The third is industry and company specific factors. So certain industry can be very risky, some industry can be very stable, and based on that you can have your credit rating. So let's say sometimes a metal can look very risky, or real estate can look very risky. Sometimes IT can look very risky, or oil and gas can look very risky. Depending upon that, your issuer, the bond of the issuer, the issuer of that bond will have higher or lower credit risk, and the investor will have higher or lower credit risk premium. All right. The fourth is interest rate environment. So when the interest rates are high, so this is what you must remember. It's a thumb rule that when interest rate goes up, the bond prices go down. Why it happens? Let's take for an example, you have invested in a bond which is giving you a coupon or an interest rate of, let's say, 7%. And tomorrow, the interest rates are going up. So technically, there are bonds available in the market which are, let's say, ready to give you 8% return. So what happens to your bond that you are holding? So your bond is still giving you 7% return, and people are not ready to buy it because there are bonds available with higher return, higher coupon rate. So at that point, what happens? Your bond devalues. So the price of your bond comes down. However, when it's the opposite, when the interest rate goes down, so technically what happens? You are holding a 7% coupon bond, and that interest rate is not available anywhere in the market. So the bonds available are of 6% coupon. So technically what happens? Your bond becomes very valuable. So people want to buy your bond, right? They still want to get that 7% coupon, right? And that is where your bond gets value, and you unlock that premium that you once demanded. You unlock that at those positions, all right? So that is interest rate environment. That's another factor that affects credit risk. Then market sentiment and risk aversion, which is always there. Even in case of equity, we have seen that market sentiment drives the premium. Even in case of credit risk, we see the same thing in bond investment. The market sentiment is the driver. If market is not good, if market sentiment is not good, then there is a very high chance that people will demand higher premium. Because again, if the future is not looking bright, you would want to get higher compensation for the risk that you are taking. Okay. And then the factor of investment and non-investment grade bonds. So, which is what we have touched, that, you know, by credit rating agencies, you get these ratings of bond, AA, AAA, AA minus, B, double B. You know, these are the ratings. Now, when you invest in bonds with higher rating, then obviously your premium you would charge will be low, because you have more trust, you have more faith that you will not be losing your principal. But when you are investing in non-investment grade bonds, which comes typically as a B grade bonds or C grade bonds, so those bonds are, and sometimes, you know, it's very prevalent in America, in the US market, junk bonds. You know, those junk bonds, they typically trade at a very, very high credit risk premium, because there's a very high chance that you might not get the money back. So people, if they get it, so they should get a very, very sizable compensation for their investment. So that was all about credit risk premium and how it impacts the bond investment. Thank you so much for watching.